Hello and welcome everyone in section 2 of this course. In the first lecture, I start by introducing the concept of support and resistance trading. Whether you are a beginner or experienced trader, I expect you to pay attention to this lecture as this information will help you to gradually build into the later parts of this course. Therefore, I do not advise skipping any of the information provided in these early lectures. Now, to understand support and resistance, let us first understand how markets work. As we all know, the changes in market price, whether you are trading in stocks, commodities or forex, are a result of constant battle between buyers and sellers. The bulls or the long traders always push the prices higher, whereas the bears or the short traders push prices lower. We also know that the price only travels in three directions: upwards, downwards or sideways. Interestingly, all markets spend more time trending sideways instead of moving up or down. Irrespective of the time frame, this sideways price movement results in the formation of price support and price resistance. Price support is also known as price floor, where price reaches and bounces upwards within the sideways price movement. On the other hand, price resistance is called price ceiling, where price is pushed lower. Insiders or market professionals often use these price congestion zones as a build-up for the next big move in the markets. A price can oscillate many times between support and resistance before the trend either continues or reverses. Guys, larger the time price spends within a support and resistance area, larger the following price move will be. This extended sideways price activity represents the levels of fear and greed of traders in that particular price region. You will learn more about the psychology of traders later in this lecture. You will also learn how support and resistance price zones from the past become key technical levels to watch out for in the future. Therefore, as an experienced trader, you are only looking for three key things. And these are also the three key things you will learn in this strategy and in this course. Identify the start of this sideways price activity on any security. Taking advantage of buying and selling opportunities available within this sideways price activity. Finally, identify the breakout to capture the large buying or selling climax once this sideways price activity ends. As we progress systematically in this course, you will learn these key things in this course and you will also be able to implement them in your trading straight away. Let us look at a diagrammatic representation and couple of examples to understand what we have studied in this lecture. Guys, in this first example, we are looking at Australian dollar, US dollar daily charts to understand the basics of support and resistance. Now, starting from this price low where the red arrow is, you can see that this forex pair has enjoyed a very nice rally in price in recent past. Next step is to label the obvious sideways price activity on this pair. This is our first price movement sideways, as you see here. Similarly, I will label the remaining price activity on this chart. The key thing to note here is that sideways market activity is clearly visible with the naked eye, so do not stress yourself too much while labeling them. If it is not obvious, it's not there. Now I will switch to one lower time frame to zoom in on the selected price areas. Guys, you will notice here that price showed very less or no violation of high and low of these price zones. This is because the buyers and sellers are most active at these price zones. I will teach you how this sideways price activity offers high probability trade opportunities when correctly studied. Now that we understand how a sideways price activity looks in an uptrend, let us understand the support and resistance in each of these. As we all know, resistance is called ceiling, whereas the support is called the floor of the sideways price activity. The final thing I want you to notice here is that how price moved sharply once this support and resistance consolidation phase ends. This attribute is linked to all markets on all time frames because the market pauses during this consolidation phases before it advances either in the direction of the previous trend or it reverses to start a new trend. Now let us quickly study support and resistance in a downtrend. Guys, we're looking at US dollar, Canadian dollar daily charts. From this price high, you can see that the overall trend is a downtrend as we speak. Once again, I will label all the clear sideways price movement on this pair. I will quickly switch to one lower time frame on MetaTrader 4 to see how price candles respected the boundaries of sideways price movement. Similar to the previous example, I will label the support and resistance on this pair. Finally, look how the trend continued after these first three consolidation phase. After all, price can only break out to continue the original trend, or the price reverses to initiate a new trend. Guys, this also concludes this lecture. This is all you need to know for the time being. Please understand these basic concepts of support and resistance trading carefully before we advance ahead to study choosing the right time frame to make consistent profits using this strategy. Welcome everyone to the next lecture in section 2, where you will study how the support and resistance trading strategy will offer great trading rewards when applied on particular time frames when compared to others. So far guys, you have studied how price moves sideways irrespective of the time frames before a breakout occurs in the direction of the larger trend or the larger trend reverses. Therefore, price consolidation within support and resistance zones apply to the smallest time frame available on your trading platform as well as on the largest time frames. However, I always encourage the use of 4-hour and above time frames for trade entries and analysis using this support and resistance trading strategy because of its three main advantages it offers in terms of pattern, price and time. Firstly, the biggest advantage of using larger time frames is that closing price of any candle represents the true market activity. This means that market professionals on larger time frames less manipulate price, and hence we can apply our trading knowledge with greater confidence. The order of high to low manipulated time frames is as follows. Those who don't know what market manipulation is defined as the dramatic rise or fall in the price of a trading instrument caused by legal authorities such as central banks, government, and large trading partners. Therefore guys, as I mentioned above, as a small trader or a retail trader, our best profit making opportunities arise when we trade on larger time periods in any freely traded market. Hence, the various candlestick patterns you will study later in this course carry much higher significance on larger time frames when compared to similar patterns on time frames of 1 hour and below. The second reason behind choosing the larger time frames lies in the fact that there is an opportunity to capture larger moves in terms of price. As a disciplined trader, you will look to capture the trades which carry lower risk to reward ratio. Personally speaking, I always take positions where my risk is always less than 1. This means that the moves I'm anticipating yield higher profits or rewards for me when compared to risk associated to each trading position. Therefore, choosing higher time frames allow me to capture moves which last for few days on 4-hour time frame, 10 to 15 days on daily time frame, and so on. The third and final reason is time. Trading is a difficult business, and looking at a trading screen constantly in search for quick profits on smaller time frames affects a trader mentally. This is where the biggest disadvantage lies when it comes to pattern and price we discussed above. Because of the market manipulation, it becomes increasingly difficult to secure consistent profits, and mostly you will end up with small profits or worse, losses while trading on short-term horizons. On the contrary, choosing a larger time frame allows you to sit back and watch the markets do their work, and you only close the trades when markets tell you to. In addition, if you're someone like me who has other commitments, you can effectively trade markets by spending around 1 to 2 hours every day to analyze the markets for new opportunities and to manage your running or existing positions. Traders, I am confident that what you have learned is enough to change your trading habits. In this strategy and course, you will also learn about my mindset towards market and how I'm always maintaining my patience to keep my trading stress-free and enjoyable to generate consistent profits. This also concludes the section 2 of this course, and I will see you in the next section where you will study a professional approach used while labeling the support and resistance levels.